Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser. Happy first week of June, and I know it's been a couple of weeks since we've done an update, so we're excited to be here today just to kind of talk about some things that we're seeing kind of globally within the market, some of the movements that have kind of continued to happen, as well as some of the events that kind of continue to be market movers. So welcome, we're glad that you're here. And so as you remember, really since February, we have been discussing the fact that markets have been under pressure after reaching those all-time highs in February. And it's really kind of been a case of Groundhog Day for the past few months where markets have really just kind of struggled to reclaim the highs that they had back in February. And there's really been a whole myriad of reasons for why that's likely. Inflation has been obviously a huge weight on markets because when we see inflationary pressure, remember, it just kind of, it makes it harder for companies to continue on the same trajectory. Things cost more, and so that has absolutely been weighing on markets, although we have seen some improvements in some areas fundamentally, particularly with jobs, and so we've been able to see those weekly initial unemployment filings kind of steadily continue to track down, which is a great thing. Now, one thing to mention that tomorrow when we see the May job numbers come out, this is going to be a really, I think, crucial time for the market because this is really going to be important for the Federal Reserve to kind of begin to make determinations about recovery of the economy. And if they need to continue to be as kind of aggressive as they've been with quantitative easing and with keeping interest rates low, they've really kind of been babysitting the market in that respect. And so I think if we see a huge jump tomorrow in new job creations, it may put a little pressure on the Federal Reserve to be able to continue to kind of defend this environment that they're keeping. And I think that will really weigh on markets, certainly in the short and even possibly intermediate term. And so we're just going to have to wait and see. So that's one of the things that we are looking at. And so also something else, just today, markets are really under pressure today. And one of the things that came out this morning was that Russia's removing the dollar from its national wealth fund and going to be replacing it with things like gold and yen, as well as the euro. And so that really has the domestic markets today kind of really under pressure for the short term. So just something that's kind of happening. Other things have been happening within the market, unless you've been living under a rock. You've heard about AMC. Yesterday, AMC was up 100%. Which is super interesting when you consider the fact that many movie theaters are not even open yet. They don't even actually have really any earnings. And so again, this is one of those Reddit stocks that I almost call it like kind of like crowd sourcing investing now. So we saw with GameStop, now we're seeing with AMC. Now they're talking about maybe funds like Bed Bath & Beyond and BlackBerry. Remember BlackBerry is one of maybe on their next hit list. So really interesting, although today AMC filed permission to be able to withdraw a significant portion of shares because, I mean, hey, their stock is now valued double from what it was just a couple days ago. And so it'll be interesting to see what investors think about that AMC wants to pull some off the table now that their shares have spiked so quickly. So those are just some of the things that have been going on. So what I'd like to do now is really just kind of get into what markets have been doing really since those highs that we saw back in February, and then kind of show you how that corresponds between relative strength and momentum. So we talk a lot about the fact that as investors, it's really important for you to always know why you own the stocks or ETFs or funds that you own, and what purpose do they have? Because they should always have a purpose. Because this way, you need to be able to say, hey, is this allocation still fulfilling the purpose for why I originally bought it in the first place? And if the answer is no, or I'm not sure, then you might want to consider kind of replacing it. And so that's the idea. So the first thing that we want to talk about is, I just want to show you, and so this should be the NASDAQ, and I'm sorry, no, this is this is the NASDAQ, and so going back 3 months through March, you can see NASDAQ's really done a whole lot of nothing. And so if we go back 6 months, we can see back in February is when we were kind of at those all-time highs. We saw that correction. We really struggled here, couldn't really even get above our 50-day moving average. And then finally, back in April, we reclaimed that. And then unfortunately, though, NASDAQ was just not really able to hold it. And so remember, the NASDAQ is a real tech-heavy index. And so tech has been particularly under pressure in these past few months as a result of inflation. That and the fact that it had just ran so hard last year. And so we're kind of just sitting right above here at our 50-day moving average. And so, but I just think it's kind of crazy to think that if we look here, we're literally starting and ending at the same point. So we've really just kind of grinded sideways for a while. And so relative strength kind of remains flat here at 55. So it's kind of, we're going to have to wait and see with the NASDAQ again. I think that with tech being under pressure, I'm going to show you in a little bit kind of where tech's momentum has gone, and I think something that's important for investors to see. S&P 500, similar to the NASDAQ, has not quite been under the same pressure, though, necessarily. And so if we look at the 6-month, you can see that we were at these highs here in February before we started to correct, but the S&P did have a better run up than the NASDAQ, although if you take a look really at 3-month, we've gone a little bit, but we've done nothing since April. If you look at just where we've been, really, I mean, we've really gone nowhere. So again, just kind of like this sideways grind. Sometimes markets need to do that to kind of, there's 2 ways to kind of cool off after overheating, and that's trading sideways or having a significant correction. Now last summer, what we saw with this was, rather than grinding sideways, we saw that 10% correction back in August and kind of leading into September. So this could be a turning point for the S&P. Is we almost achieved all-time highs this week, but we've not been able to really reclaim it. We've kind of like touched it and then come back down. Again, relative strength is kind of now sitting flat at 58, and so there could be room certainly for the S&P to move, although again, I think markets are also still waiting to see what the Federal Reserve's response is going to be after this jobs report, and if they're going to continue to kind of support markets the way that they have. Now, I told you I wanted to talk to you a little bit about just kind of momentum in the market and what we've seen, and so this is one of the technical indicators that we follow, and really what it does is it just takes a look at all the areas of the market and then ranks it by momentum and relative strength, showing us where are the areas of the market that are kind of increasing in momentum and more favorable versus decreasing. And so if you look at domestic equities, believe it or not, it's been all of the small caps recently that have, within the past few months, that have really gained strength, and so followed by mid cap. Now large cap, blend, and growth has really been under pressure these last few months, which isn't really surprising, because remember, particularly areas like big tech and those big areas of growth that really kind of like carried us out of the pandemic last year have been the ones that have been the most under pressure these last few months, with especially with the inflationary fears. And so these big areas like Facebook, Twitter, Tesla, Apple, they've all kind of been like underperformers, and these small caps have really kind of rotated. And now, I don't think that means that you just kind of cast large cap away, but it's an interesting rotation that we've kind of seen that we should be mindful of. Now, within the sectors, this is, to me, a pretty important change. So consumer cyclical, which is kind of those areas of discretionary spending, and so we've talked really since last summer about why we had added consumer cyclical and discretionary, and those have continued to be great outperformers for us in areas of strength. But something that's interesting, so for a long time, technology was in the #1 slot, and then consumer cyclicals was #2. Well, tech has fallen all the way back here. And so financials, basic materials, industrials, and even energy is all ahead of it right now. And it's because of this. Now, this is one of the reasons that while we didn't cut our tech exposure completely, we did downsize some of our areas of tech, and we're very, very specific in what areas of technology we have exposure to now, because we have seen this kind of gradual weakening and then kind of confirmed that right now tech has lost some momentum, particularly in the areas of some of the subsectors like communication. And so financials is an area that we actually added some exposures to in some of our portfolios, because it's had significant kind of strengthening and positive relative strength, and so that's kind of been an area that we have been watching, and then we did add. And so again, not saying that we should, I think that over the long run, tech is kind of always going to be here. Something that we're always going to be kind of looking to the future for, but it's important to kind of, again, know, why do you hold your allocations? What purpose do they have? And if that particular allocation is no longer working, then holding on to it until it works again is usually not a great long-term strategy. So the idea is that we want to be able to kind of pick those areas of strength and be in those areas, exposed to them, kind of avoid the laggards. And then when those areas cycle again, there's nothing wrong with kind of going back into those areas when they move back into favor. And so we think it's important. You want to be non-emotional with this. So you just want to find a rules-based process that you can follow. So no matter kind of like how you're feeling about it, say, hey, these are the numbers, so it's time to make a move. That's kind of the way that we operate. And so just kind of wanted to share that with you. But really interesting movements that we're seeing within the sectors, and so areas that we're following. So that's really what I wanted to get into today. Obviously, as we kind of looked and see, markets have not really done a whole lot over the past few months. They've kind of, again, traded sideways. What I'd really like to, we'll be waiting to see is the kind of where we're going to go from here. Now, summer tends to be a little bit of a weaker time of the market. That's just kind of like what happens. So it'll be interesting to see if markets can still kind of break out above and move higher, or if we're just going to kind of keep grinding sideways like this for the next few months. Only time will tell, I guess, with that. So I thank you very much for joining us today. If you have any questions, you can always reach out to me, AshleyR@victoryfiduciary.com. We're always happy to take your questions, comments, if you have ideas for new videos. Really excited that we're going to be working with a local realtor in the upcoming weeks. She's going to come on with me, and we're going to kind of do like a Q&A session to help our clients kind of answer some questions about this real estate boom that we've been seeing, and ways that you may be able to take advantage of that and also add to your wealth. So looking forward to that. We'll be announcing that soon. Thanks so much for joining us. Have a great week.